Alex Black, Rio2 Ltd, in construction on our 5 million ounce Fenix gold project in Chile. And it's good to be back on with Crux Investor.
Fred Earnest, President and CEO of Vista Gold Corp. We own the Mount Todd Gold Project in Australia, where we're about 5 weeks away from completing a feasibility study on a much lower capex, 15,000 ton per day evaluation of the project.
Guys, thanks so much for joining us. In fact, Fred, that is exactly the topic that we're talking about today. You both moved towards a phased development, i.e. going to reduce the kind of capex, reduce the output initially. What were the sort of technical or macroeconomic triggers for this shift for you, Alex?
Yeah, look, when we inherited this project, remember we didn't discover this project had been around and discovered back in 2010 to 2014. You know, the owners of the project then did a feasibility study with the biggest possible capex, biggest possible throughput. And the reason they did that was because they were looking to sell the company and move it on, but they weren't successful at doing that. We looked at that study and we downsized everything, just like what Fred's doing in Australia right now. And I've been watching Fred from a distance, and they're doing a great job. Is to reconfigure the project so that it's doable. I mean, you know, gone are the days where you build a story up and tell everybody that you're going to flip the company and sell it to somebody. I mean, the chances of somebody coming along and buying you out is very slim in this market, irrespective of the fact that the majors have got, you know, record levels of cash, et cetera, et cetera. So really what you've got to demonstrate is you can do it yourself. And so that's what we did. You know, we downsized the project. We have a starter project, which can be expanded. I think very similar to what Fred's going to show when he puts his study out. The project can be expanded, and we'll do that. But we become a miner sooner than later, and we are able to fund it ourselves. So I'll let Fred talk about his project. But you know, that's essentially, I think, what both of us have done is downsize to demonstrate the ability to build ourselves.
And Fred, I mean, tell us a bit about your project.
Yeah, you know, it's interesting to hear Alex describe what they're doing in Chile. Certainly, as we acquired Mount Todd, it was initially only 3 million ounces, and we started exploring, and were very successful. We got the resource up to almost 10 million ounces, and based on that, we started looking at what we thought was the optimal size for the project. And for a number of years, we believed that 50,000 tons a day, producing somewhere between 350 and 500,000 ounces of gold per year, was the optimal size for the project. And as we completed a feasibility study in 2022 and updated it in 2024, you know, like Alex just commented, seniors who you think would be interested in projects of that scale are actually much more interested in acquiring producing assets today than taking on development risk. And so we've stepped back and are looking at how do we reduce the capex? How do we get this down to a scale that it can be built and financed in today's market very efficiently? And we've opted on or settled on a 15,000 ton per day project that has the capacity to produce between 150 and 200,000 ounces of gold for a much longer period of time, leaving ultimately the expansion decision to some point in the future that I believe will be driven by some things that the deposit will dictate, and other things that the market will dictate. So it's a very interesting evolution of thinking about how a project should be developed.
And not only that, I mean, I think what we're both doing, Fred, and we've obviously done it, is simplifying the project, right? In our case, simplifying the flow sheet. And by that, I mean that the previous work that had been done on our project contemplated dual stage crushing, maximizing recoveries at over 80%, et cetera, et cetera. And we looked at it, but that came with a huge capex, right? And we looked at it and said, well, this could be potentially run of mine, and we can forego having a crushing circuit, therefore reducing the capex, and we'll worry about that later, right? Just like you're saying in your project is get it up, and then see where you evolve depending on rock hardness, rock recoveries going forward, etc., etc. So I think what you're seeing, and maybe we're not the only ones doing this, but simplification of projects, despite the fact that we've got a fantastic gold price, is important to get a project off the ground, to I guess demonstrate proof of concept to a certain extent, and then evolve from that point. I don't know if you agree with me there, Fred.
And one of the other things that we've done is, previously looking at a large scale project with a specific audience of being, the likes of the barracks students of the world. We had a set of design criteria that would be very, very much in line with what they would use to build a project. After visiting a number of Western Australia gold mines, we've changed to more of a, we call it internally, we call it Aussie rules, but I guess fit for purpose, a better description of what we're trying to accomplish. And we've selected, we've changed our team on the evaluation a little bit from past studies. We're using GR Engineering Services, or GRES, and they have a great track record of designing and delivering projects in Western Australia on time and on budget. And so we've changed our thinking. Rather than designing a project that's very international, or at least North American in its mentality, we're now thinking of how would an Australian mid-tier producer build Mount Todd, and I think that's important. Sometimes we get carried away trying to go over and above and beyond what is absolutely necessary, and the Australians are very efficient at building operations, both size and just the way they design and materials they use and the construction techniques, and we're trying to incorporate all of that in our study to take advantage of the in-country experience, and as we rethink Mount Todd.
When I look at something like this, timing's everything, right? Timing is usually the arbiter of success in most cases, and a bit of luck. Do you think there's going to be a time soon where the mid-tiers are going to have to look at development stories, or are development companies going to have to do what you do and say, look, we're going to have to take control of this, we're going to have to put ourselves in positions to demonstrate we can get into production, and we will get into production, and we don't need to wait to be taken out? Because at the moment we're seeing lots of mergers of equals, i.e. existing production buying existing production. It's not yet kind of buying new ounces. So I'm just trying to think of the kind of financing environment which advanced developers have to play. Are they going to have to all do what you do you think, Alex?
I think so. I mean, I think, look at it. We've got a $3,200, $3,300 gold price, and they're not buying developers. I can tell you, quite openly, nobody's knocked on our door, right? Given what we're doing in Chile, and that's fine. But I'm just letting you know, nobody's knocking on our door, and we're in construction phase. So I think that tells you something, that no, the big guys don't want to take the risk. They would like to see companies like Vista Gold and Rio2 get their projects off the ground, and then maybe they might come around and have a chat and see what you're doing. And apart from the spectacularly sort of high profile development stories, if you want to call them that, like for example Snowline, or in the Yukon, or if we look at the thing that Kinross bought, Great Bear, right? That was high profile, and they stepped in there. But they're very rare. I see them to be very rare. Fred, what do you think?
I think there's a part of all of us that are in the industry that look at this rationally and say we can't continue to do what we've been doing. That at some point there has to be a fundamental shift. That people have to start looking at development stage projects. However, our view is that maintaining optionality is the key to our success. That we can't be locked into and dependent on someone else to come along and say, I really like Mount Todd, I want a joint venture with you, or I want to buy it. We part of the purpose for this study is to demonstrate that we have a project that we could, like Alex has done at Rio2, that we could actually, get the CapEx down to the point that, it's something that we could finance, build the team, and build this ourselves. It's I think that Alex is right. I think we're in a market where, kind of, hearkening back to the line from the Field of Dreams. If you build it, they will come. And unfortunately, that's I think the reality. Even though we think that at some stage there's got to be a swing in the pendulum, it's got to start swinging back the other way. We're preparing ourselves to, and we're designing the project so that we could, if that's the option that's presented to us and the market is supportive, we could move forward aggressively to develop Mount Todd.
Field of Dreams is a great analogy.
Field of Dreams.
Yeah, great analogy.
I don't know if it always works, but okay. For this sake, let's say it does. But I mean, it's kind of an interesting thing. You're talking about the high price, gold price doing what it's doing at the moment, 3,300 is fantastic. Everyone should be able to make money. But for you guys having to build your own projects out at smaller scales than initially, just kind of get going, proof of concept, etc. You're going to have to look at things like you're going to have to, I guess, make choices about things like, processing plant redundancy or layout considerations to allow for future modular upgrades. So you can maybe capture some of that efficiency further downstream. Or how do you view those sorts of things, Alex?
You build that into what you design initially, right?
Day one, okay.
So, yeah, I mean, in the case of Fred, I'm sure he's got because he had a big engineering solution for this for his project in the past. He's got an idea of what the ultimate layout's going to be. GR engineers who are doing the work now will be taking that into consideration with their design planning and criteria. It's the same with us. In the case of what we did at Fenix Gold was, if you've seen the videos and other things that we've put up on social media and on our website, you'll see that we cut a platform for our processing plant. And what you'll see is that area is very large in comparison to the fact that we've only got one train of tanks, right? Leach tanks. And the reason it's such an expansive area is we've designed it to cater for our future expansion to 80,000 tonnes a day, which will see 3 trains of leach tanks come into play. And so, yeah, you try and do things so you don't become redundant. Just talk about redundancy. I mean, one of the things that we considered was doing single stage crushing, and the benefit of doing that in respect to recovery and economics wasn't huge, but we could have done it. But we thought about that and we said, well, if we're going to expand the project in 3 to 5 years, why are we going to invest in single stage crushing for a 20,000 tonne a day case, which then becomes redundant, and we've got to upgrade it with something considerably larger? So why don't we try and start off with run of mine? We take, the 1 or 2%, differential in recoveries, and then we worry about a crushing solution in the expanded project. So you think about all these things in doing your initial design for the future of the project as well.
Okay. And what about things like managing recovery rates and metallurgical consistency when you kind of got this kind of staged throughput versus full scale design? Again, is that something you can factor in at the beginning or manage somehow?
Well, but I think it's quite interesting, and maybe Fred needs to comment here, but you know, mining and gold production is not an exact science, right? There's a lot of trial and error and other things that you got to go through, and we're going to do that with the startup of our project, and you know, we're going to try different things with regards to reagents. We're going to try different things with regards to, you know, bench heights on the leach pad, et cetera, et cetera. And they're not things that, if you try them, become a showstopper. They're just things that you want to see what happens, and et cetera. So recoveries might fluctuate as a result of trying some of those things, and so what people got to understand, you know, this is, you know, even though we try and replicate becoming a widget factory and producing bars of gold, which are our widgets, it's not an exact science to get to that point. And so, you know, in our case anyway, with heap leaching, there's a lot of things that you can, you know, fragmentation, you know, blast patterns, all sorts of things that you can play around with to get your ultimate production rate going.
Right. And like, I mean, Fred, just on, I guess, trying to understand the kind of logic and the thinking, you kind of downscaled to like 15,000 ton per day plant, I think, you know, and Alex, you're sort of moving from 20 to 80. You know, all these numbers need to be decided. There's trade-off studies. There's, you know, you got to look at the economics of the thing. But for you, what sort of throughput and infrastructure constraints kind of drive those sort of inflection points, those 15,000 versus 18,000 versus 12,000?
You know, you know, just comment one thing. You know, Alex said, you know, allowing for modularity, allowing for expansion. You know, making sure that your general layout is suitable for an expansion is critical. You know, at Mount Todd, we've looked at plant sizes from 7,500 tons a day up to 65,000 tons a day over the course of time. Some of it in 2,500 ton per day increments, in places 5,000 ton per day increments. We've evaluated a lot of different plant sizes, and sometimes what it comes down to is sizes of equipment. You know, realistically, it's a stair-step function that you select a certain crusher package, and you can't vary it by 1,000 tons per day. You know, it kind of comes in bigger chunks, and so, you know, when we look at the sizes, you know, we're looking at, you know, what equipment package would we select? And there's tremendous investments, you know, as Alex has pointed out, you know, in deferring the decision to install a crushing plant. There's a significant investment in crushing equipment. And so from our perspective, given that we have an ore body that's recognized as being a hard ore body at Mount Todd, we've spent an incredible amount of time on the testing side to make sure that we select the right equipment. And you know, we've from past experience, Mount Todd operated previously, and so we know that, you know, gyratory crushers and cone crushers work fine. We believe that you know, being slightly oversized is a good thing, just given the hardness of our ore body. But we've spent a lot of time on HPGR crushers, for example, and have sent an awful lot of material to Germany for test work. But you know, spending the time to evaluate and make sure that you make good decisions up front, I think, is one of the keys to spending your capital wisely. You know, to make sure that you get the right equipment, and that you get the size of equipment that will meet your needs without being too big or too small. And you know, so that's one of the things that we've spent a lot of time on up front, is trying to make sure that we get the right mix, the right equipment selected.
Right.
I think there's two views on, you know, future expansions. You know, one is reflected in the way Artemis has designed their project, you know, and saying very clearly up front, you know, we're going to start at this size, we're going to expand in year X to this, and then after that we're going to expand again, and they've got it very well mapped out. Capricorn Resources at their Carlawinda project adopted the other philosophy, which is, we're going to build the project at this scale. We're going to design it on a fit for purpose basis, And if we make the decision to expand it down the road, we'll deal with that at that future time. And they're presently looking at expanding the Carla project. And so they did not design in, extra capacity in the primary crusher, for example. And that's kind of where we're at. We're looking at it from the point of view of it's uncertain whether there will be an expansion or exactly when that will happen. And so the most efficient use of capital today is design and select equipment for the project that we're contemplating. And if market conditions and the deposit itself combined together dictate an expansion in the future, then that will stand on its own, and there will be decisions made and equipment installed at that point in time. There's no reason to spend money today for something that there's no certainty will happen in the future.
And what about things like, and it's really, really important, you've both made it clear, it's important to show that you can move forward through the development phase into production, get cash flowing, you get massive branding points and rewards in terms of valuations on that. Are there things along the way, like the kind of with the smaller projects, the more modular projects, where you're marked down? Like for instance, are there kind of like trade-off studies with regards to the kind of I guess the reserve classification, for instance, which institutions might be looking for, but and then cumulatively all those other things that we've kind of talked about, up until now in terms of redundancy and layout considerations and being less efficient somehow. Is it worth it initially to kind of say, well, let's not worry about that now?
One of the advantages we have at Mount Todd is having a very large ore body. We have the ability to, if I could use the term, play with the grade a bit. We've even though our break-even cutoff grade is somewhere in the range of 0.25 to 0.3 grams per ton, we've in the past designed to a 0.35 cutoff, and for the purpose of this study, we're designing at a 0.5 gram per ton cutoff, with the specific goal of grade pays, tons cost. And we're gonna segregate this low grade fraction, the 0.35 to 0.5 gram per ton or gram per ton material, in the corner of the waste rock dump, so that it could be processed at some future time. But for the present, we're raising the cutoff grade with the idea of raising our reserve grade, and we believe that at Mount Todd, that 5 million ounces at a gram will have greater value in the market than 7 million ounces at 0.77. So there's some other things that we have the flexibility to do, particularly in our case with a large deposit and a deposit that has a higher grade core in the center of it, that we're able to, perhaps engineer the project a little differently, not just on the throughput, but actually looking at what ore is going to go to the mill and what ore is going to be segregated for some future time.
So are we saying that kind of the early stage cash flow generation versus the kind of long-term ore body, I guess, depletion or resource sterilization, that risk is worth this kind of smaller strategy initially? Is that effectively what you're saying?
Absolutely. The things that you can do to maximize grade, to increase production, increase cash flow.
Initially, yeah.
There's some things in the market, and Alex has probably dealt with this more than I have, but he's got a heap leach operation, and he's got some very distinct advantages that I don't enjoy. But for milling operations, there's a very strong bias toward projects that are approximately a gram per ton or better grade. Even though there's some very large projects that, the Boddington operation, their head grade to the mill last year was 0.62 grams per ton, and Detour Lake, their feed grade was 0.85. And both of those operations made a lot of money. There's a bias in the marketplace among investors toward projects that have grades for milling operations that are a gram per ton or better. So we're trying to focus on that and achieve that objective. And by doing so in the first years of our project, I expect that we're going to be in the 1.1, 1.2 gram per ton range. And that's just through mine planning and mine scheduling and maximizing value that goes to the mill in the early life of the project. And I'm sure that Alex has done the same thing with the heap leach operation, that they're trying to get some of the best ore on the pad early to maximize cash flows and generate returns to pay off capital.
Yeah, spot on. I mean, it's exactly what we're doing. And yeah, we've got different types of deposits and different types of challenges and benefits. But yeah, no, you're spot on there. And you don't lose the gold. I mean, the gold stays in the ground, the gold that you don't mine. And obviously, depending on what happens to the gold price going forward, you could always, have a plan to recover some of that gold that you've left behind. So, it's never lost out of the resource inventory. But I just wanted to follow up on what you were saying, Matthew. It's quite interesting, and I think don't know if I got your question right, but one of the things that happened to us was that we went through a pretty tough time with our EIA approval process, as everybody knows. And then we financed the project in October last year with both debt and equity. And to turn on essentially 100,000 ounce per annum gold mine in the initial stages. And all I got around that time post-financing was, so talk about the expansion. What's the expansion look like? I said, give me a break, we haven't even built the first project yet. So, size and other things are obviously in people's minds, not in our minds. I mean, we obviously feel that size will come, just probably like you do, Fred. But it's just interesting how investors, and I still get it, and these are institutional investors. They go, yeah, so how's the plan going for the expansion? When do you think you're going to get up to that level? Blah, blah, blah. And it's just amazing. But you can never satisfy everybody, I guess.
It's the irony of it. It's too big. It's too big. And now it's, how big can you get this thing?
Now it's a little small, can you get it even bigger than that?
Well, that's what I'm sort of laughing about timing, is they say being the arbiter of success sometimes. It's, I wonder if in today's market it'd be any different. I don't think it would be, because the access to conventional cash is not available to many. There's not available to many, especially the $1 billion plus type level. So, but that might change as some of these sort of bigger advanced development stories kind of, get off the rank, and there's less choice out there for some of the mid-tiers and majors. But it's not there yet. So I think you guys have come about it the right way, as far as I can see. The cost of money's obviously, working out for you. But let me ask you, Alex, with regards to, just to your point there, are there kind of elements of the previous sort of large-scale feasibility work that you've done that could be plugged back in seamlessly during the expansion phase, or re-engineered as required?
Well, as I said, maybe we're going to introduce crushing to the process. We just don't know yet. When we start up this project, there'll be a lot of playing around with explosives and fragmentation and other things to see what sort of size of fragmentation we can achieve. Yeah, what they had designed in the pre-feasibility study that was done in 2014, is something that we'll eventually potentially get to, so there was some good work done back then, but obviously we've done like what Fred's done. I mean, Fred's done exactly the thing that we would have done, is Australianize his deposit, and we've Latinized, or I don't know what you want to call it, our deposit, and brought in our engineers that built La Reina and Shawindo to design this. So we've changed a few things. Our approach to things, etc., are different from the big engineering study. But I mean, there are some things there that we can aspire to seeing in our expansion project. But obviously, water's the big thing for us. But anyway, sorry.
Well, I was gonna, we'll come to water, believe me. We'll come to water.
Fred's got too much. Well,
We
the
got water
reason
questions.
Fred is we've been talking about building a pipeline from the Northern Territory to the Atacama region of Chile underneath the Pacific Ocean to see if we can, or fly it over. We don't know, but the feasibility studies haven't actually worked out for us, and we're still running the numbers. But that's how I got to know Fred, because he's got too much water, and I don't have any water.
Different in annual precipitation between our two projects.
Just a bit. Just a bit.
Just a bit. Just a bit. Fred, you did contend with fires a couple of years ago as well, didn't you? So it was like hell and brimstone, is it? If that's the phrase. I mean, Fred, what about you from that regard in terms of plugging back in some of the work that you've done as you expand when you get to that stage? Is it going to be easy?
I fully expect that we're going to come out with a feasibility study at a 15,000 ton per day operation, and it's going to involve many of the same elements that were in our last feasibility study. That we've there's been some trade-off studies happening in the midst of the feasibility study, and we will likely look at a couple of ideas that could result in simplification of the flow sheet. It may, at the end of the day, it may be like Alex has, they've made the decision at Rio2 that, maybe sacrificing 1% or 2 or 3 on recovery in order to save tens of $millions of CapEx may end up being the final design. And that's something that, we've just in the last days seen some numbers on a new study that would be looking at slightly different combination of primary and secondary grinding equipment. And so there's some things we're continually learning and trying to absorb the lessons from past test work and put them in the context of today's market, and ultimately I think that the project that we will build at Mount Todd will be slightly different than the project that we're going to present in this feasibility study, because of that very factor, that there's been a huge body of test work and previous work completed. And the important thing in our industry is, we can't just easily switch out a unit if we don't like it. And so we've got to learn from the past and make the very best decisions, because oftentimes once we make them, we're stuck with them for a while. So we're anticipating that there will be a bit more test work, and until you make the decision to build the project that you've designed, you have the flexibility to be able to make changes.
Right. Okay. Alex, you brought up water. Let's talk about water just a little bit. Okay. In terms of the water usage per ton of ore modeled across all stages, is there sort of kind of a cost component, a switchover component when you can transition from truck through to desal supply, or is it relatively seamless? And when would that happen? When would you imagine?
Yeah, I mean, look, the reason we're doing 20,000 tonnes a day to start off with is because we can justify trucking the water to the project for that size project. We've been working on analysing water options, where I think we're only maybe a couple of weeks away from announcing something in respect to our selection in respect to desal water for the future. There's not going to be any risk of us not, securing a desal solution, so that's going to happen. It's all going to be about timing, etc., which will come out of our expansion study that we hope will get finished by the end of this year. But yeah, it'll be relatively seamless. The pipe will be delivered to the project, and we have the water facilities that we will be utilising for the trucked water, storage, etc., that we'll be using for the desal water. And as you probably know, that we also will be coming up with a solution that will cater for other users in the area as well.
Okay. And obviously, for you, Fred, you've got the feasibility coming through. In terms of things like ore sourcing, is that sort of being deprioritized with this kind of new plan, or is that still part of essential to your grade control?
Actually, we've modified the ore sorting circuit. One of the things GRES has done is that taken a fresh look at that, and instead of having two stages of ore sorting, we're going to drop the laser sorting. At a very large scale, it makes economic sense, but at a smaller scale, when we look at not just the material balance but the gold balance, we really don't recover enough gold at a small scale to justify the expenditure in the laser sorting equipment. Whereas the XRT sorting still makes a lot of sense and allows us to get rid of something on the order of 10 to 12% of the run-of-mine feed. So that ore sorting is still in, but it's not the same ore sorting concept that we had contemplated previously. On the water side, it's kind of interesting. We have to treat water so we can get rid of it. We don't have to pump. Gravity flows to the plant from our freshwater reservoir, so we're quite opposite on that front. But the ore sorting, that's one thing that we've had a bit of a rethink and simplified that part of the flow sheet.
Okay, well, let's talk about something that you do in common, things like tailings designs. Obviously, Rio, no tailings model in place, is there?
No, for us, we don't have tailings, but we have a leach pad. And obviously, there's different design criteria related to leach pads versus tailings. But we're lucky. We don't have tailings deposition sites.
Right, but Vista has a permitted but unused TSF capacity. So what are you doing, Fred?
Well, tailings design criteria is probably the most dynamic part of permitting and design in our industry right now. It seems that every time there's a new tailings failure, that we get a new set of regulations, design criteria, and so we, for our feasibility study, we brought in a fresh set of eyes to look at the tailings side of things. But we're fortunate; we have plenty of space, and at a smaller scale, tailings is easier to manage because you have in the facility that we already have existing, we have more surface area, we have more time for settling and compaction, and so we're not pressured to build the second tailings storage facility with the smaller scale like we would have been in the previous study. So right now we don't anticipate building the second tailings storage facility until the year 9 or 10.
And there's a big chunk of capex that you're deferring. That's good.
Absolutely.
Right. Okay. That's fine. I was going to get into sort of equipment downtime stuff, but I don't think we'll bother with that for now. In terms of, let's go to the financing thing, because you mentioned it earlier. Equity, debt, and some gold streaming from you. It's been a tough few years, right, for everyone, for lots of reasons. But the capital seems to have left the space. Do you think there's a sort of new regime of capital required? We've seen people starting to use the phrase alternative financing again, but it looks very different from when I was in banking a few years ago.
I still think capital's discerning. It's not going to anything at this stage. And I think, explorers are still doing it tough. Developers, a little bit easier. But obviously, capital's still discerning, I think, as to where it's going. For example, Andrew Cox and I are marketing next week. We're going to be in New York on Monday and then 3 days in Toronto. And it's interesting. Some of the funds in New York won't invest in non-producing stories, right? They've been burnt so hard, or so badly over the last 10 to 15 years that they've steered away from development stories, and they'd rather wait. And so we're marketing to people that are not invested in our story, that we're trying to get warmed up to the fact that we will be a producer at some point, hopefully early next year. But I think I would say it's still discerning, and it's not easy, not for everybody. But for people like us, and I'm sure for Fred, once he puts his study out, there is money available.
Yeah, and it seems like if I look at recently out in New York, you've seen America's Gold and Silver, and you found gold raised between 180 million bucks in the last 2 weeks. These near-term revenue stories seem to resonate for sure in America.
It also depends on who's involved. America's Gold and Silver. Obviously, Eric Sprott's there with a big chunk of it.
Well,
that
both
helps.
actually. Yeah.
Yeah. So look, I think there's money out there, and if you had to do a deal, I mean, if we needed $100 million, this is Rio2, to do something significant that adds value and is accretive to our story for whatever it might be, no problem. I mean, that money's out there, so we're not in that situation at this time, but it's very discerning. It's money's still looking for management teams that they feel comfortable with. They also want to see a story that has some growth to it and some ability to develop into something of size. So the money's there.
The money's there for CapEx. We're talking about CapEx specifically in both cases here. I think earlier stage money seems to be a little bit more hard to come by. Discerning is a great word, a great phrase, looking for good management teams with track records. But I think the vast majority of companies are struggling to attract interest, even with these kind of gold prices at the moment, it seems. What about you, Fred? Obviously, you've got all this joy coming up ahead of you. Once you get this feasibility study out, you're gonna have you been already just sounding the alarm, letting people know that you will be coming and talking to them? Do they know what to expect?
We've got 15 million in cash right now, so it's not something that we need to run out and go pull the trigger on a finance. A week after we announce the results, I fully expect that we'll do something in the next 12 months. Doug Tobler, our CFO, and I were just in Australia 3 weeks ago, and exploring and kind of taking the temperature of the Australian lending institutions. We see strong support from the Northern Australia Infrastructure Fund, and that would be on the debt side of financing the project. If we were to build it ourselves, they would probably be a key cornerstone. The Australian banks, on the debt side, we see strong interest in gold projects, and the equity side, we don't go to the market very often. The last time we went to the market was in 2020, and so when we raise money, we raise what we need, and then we treat it as a scarce resource and shepherd it very carefully and try and maximize the value that we get. But I think that what Alex says, right? Explorers it's a bit more difficult for those of us in the developer space. People are discerning, and they look at management teams, they look at what you've done, they look at your project. I have no doubt that we'll be able to raise the money that we need at the appropriate time. And for us, it's all about minimizing dilution and getting the best deal that we can to meet our future needs, and at the same time protect the investors that we already have. So it's it's a bit of a chess game. And it's something that we're always watching and carefully evaluating and making sure that we don't play our hand too soon.
And Alex, for you, when you were having discussions around financing, I mean, was the kind of optionality of expansion available to you? Was that modeled into the kind of cost of that capital that you were able to go out and get, or was it based on today's numbers?
No, I'm just talking about the interest out there. I mean, there's interest in supporting us to do other things. There's interest out there, obviously, for the expansion of Fenix Gold. No, it's not been built in anything that we've already done. For both Fred and ourselves, we don't have a profile investor in our story. I mean, we have Eric Sprott, but Eric's been there since 2019, and it's he owns 7% etc. But when I talk about profile, the Lundins, the Ross Beatties, the Richard Walks, etc. If you look at those guys, they've got a huge following. Whatever they touch, whatever they do, there's people that pile in and all that sort of stuff. Neither Fred or I have that sort of phenomena related to our story. So, we've got a bit of grind, and we've been, certainly from our point of view, we've been grinding and talking to bankers and trying to get exposure, talking to sales desks at various banks about what we're doing, et cetera, et cetera. And, that's what we've got to do. We're not highly researched, neither's Fred. I don't know what the value of research is these days, because unless you pay the street, you don't get it. And Fred's smiling there, so he knows the story. But we're not highly researched as a lot of these other companies are, and we're not covered by BMO or CIBC or Canaccord or those sorts of usual suspects. So it's an interesting game. We just, like, we clawed back from the disaster we had with our EIA. We're clawing our way up, in the market and waving our hands and saying, we are real and we are doing this, and we are going to be a force to reckon with as we get further down the track.
How do you? I always think, like, prices like this, gold prices like this, it kind of covers a multitude of sins. There's a rather glib thing to say, but it's kind of true in the sense that the bankers get a little bit lazier because they think the margin is there. But you're still kind of focused on risk-adjusted return metrics when you're kind of doing these studies, when you're sitting in with the ops team saying, look, guys, we need to focus on whatever criteria you guys focus in on. Do you feel that? Do you feel that you've kind of got some? Do you feel you kind of got a little bit more breathing room with prices like this, or is it really this may not be the case tomorrow, so you've got to always be on top of it all?
Well, I think it's nice to have a gold price environment like we have right now. Obviously, what I keep saying, and obviously I think Fred's in the same position. We both don't have marginal projects. What Fred's dealing with is managing CapEx and trying to come up with a good starter project. We did that, and our projected ASIC is 1250 going forward. So we don't have a marginal project, even if gold was to halve tomorrow. And Rick Rule's been talking about this on Twitter. So just interesting that he's been talking about the probability that gold could halve during this bull run, right? So obviously things can happen, but so we don't have marginal projects, and what is first and foremost in our mind is just executing and delivering, right? I mean, we don't know, and this is just the way our project is, and I think for any startup producer, we project what we think is going to happen, but we really don't know until we actually start processing, mining ore, processing it, putting it on a heap. In the case of Fred's, putting it through a mill, et cetera, et cetera. We don't know that, but what we got to do is just execute and deliver, and then manage the whole process of riding through the bumps of startup and trying to get to what we're projecting that we're going to do, right? So it's a very simple process, but it's difficult, but it's simple, right? And so my team right now, because we are in this construction phase, it's just all about executing and delivering, as we say, on construction, which means time and budget, and that's what we're doing. Then when we get to production, it'll be okay. Now we've projected 1250. Let's do it, right? Let's achieve that, and that'll fall out over the first 6 to 12 months of production. We'll see if we were right. Fred, I don't know if you want to comment on that.
It's all about managing expectations. our previous feasibility study, we used an $1,800 gold price. Obviously, the gold price is much higher today, but we continually look at long-term projections on gold price we use a base of 13 banks. And for our feasibility study, we're probably going to use a gold price that's going to be around $2,300, maybe as high as $2,400 an ounce. And that leaves, like Alex said, we don't have a marginal project, but we're going to be able to demonstrate very solid economics at a $2,300 gold price. And if spot is 1,000 times higher than that, well, that just says that, payback on initial investment, returns to investors is going to be substantially higher than what we estimate in the feasibility study. And so, we play the long game. We play the game of managing expectations, making sure that what we generate as what our expected plan is achievable. It's kind of the under promise and over deliver mentality. But it's we've got a wonderful gold price, and even if it was lower, we still have a wonderful project. And that's that's where we're at. Is let's stay focused on what's really important, and not get way up, to use a Colorado term, not get too far out over our skis.
Yeah, well, no, I agree with you on that one. But I think that's a great way of looking at it, because we always look at kind of fundamentals. Like, I can sit here and work out weighted average cost of capital and payback time and stress test the NPV multiples, etc., like as I used to do in my banking days. But the reality is now I look for companies that I think can actually get into production, because I don't think many can, stay in production, hit those margins, make those margins, which is getting, it's not easy. I think the average sort of ASIC numbers that we're hearing now are sort of $1,400 to $1,500 for start. It used to be anything under 1,000 was good. I think anything under 1,500 is good, quite frankly, now. So there's a kind of I guess the sentiment in the banking community is changing to which teams are actually going to get this thing done, and not make this a paper exercise of what could happen. So to say companies like you guys, where you're mine builders, and have got a record, the team's got a record, that's very attractive and will become more and more attractive, is where my head is at. So look, on that good news, I'm very conscious of the time here, so maybe you should wrap it up, and we can always sort of come back. I do have lots more questions, but what I've been looking for is sort of clues as to how you guys think about making decisions to do the things that you've done, and I think more importantly, looking at companies that have changed. I think the definition of insanity is just trying the same thing over and over and hoping for a different outcome. You guys have changed something big, and I suspect changed the fortunes of your companies when you did do it. So, Alex Black, thank you very much as always for candid commentary, and Fred, Ernest, I do appreciate you coming and joining us and talking through your decision making too. Thank you, gentlemen.
Thanks, Matt.
Thank you.